Hello traders, Nick Shaheen here looking at the banks, the financials, the stocks. So XLF is the ETF that everybody knows for the major banks. KRE is for local. So not talking about the locals, talking about the majors. So XLF is a better representation. So the meme is that banks cannot hold their rallies. Banks cannot rally, blah, blah, blah. And let's see how we can invest that. Recently, the stock market, as far as the banks shares, are whipsawed back and forth by the movement in the bond market, and for good reason. But before I forget, before I go on, I should say that at the end there'll be a subscribe to this YouTube video, the YouTube channel, I should say. A little thing that pops up on the left. It's free. If you're not already subscribed, hit it. It would help out greatly. Okay, back to the banks. So the bond market in the U.S. is going gangbusters. The bid for the TLT, for example, that's the ETF that represents the 20-year bond in the U.S. itself, not the yield. It's the yield. So it's going through the roof because people want to buy it left and right. Who's buying it? There's an acronym out there called TINA, which actually stands for There Is No Alternative. Imagine if, big money wants to hide in bonds, fixed income. If they want to do that anywhere outside the U.S., they are guaranteed losses. What? Yeah, because there is negative rates. So the German bond, 10-year, I think, is almost minus 0.8%. So you give the government money, they give you less back, guaranteed. So there is basically no alternative for them but to bid our bonds in the U.S. But that also works for stocks because the stocks yield more than bonds. I mean, yeah, you don't lose money by buying the U.S. bond, but you're only getting paid 1.5 on 10 years, 1.4 or 5 on 10 years, or just under 2. Is it over 2 back? No, still under 2 on 30-year bond for the U.S. Yeah, it's better than negative, but it's still nothing compared to what the stock market usually pays. And this year to date, it's still over 10. 15% S&P, 10, 12%, whatever it is. So TINA works for stocks and bonds. But anyway, the bond market is rallying, which means that the yield is falling off a cliff. That's the 10-year yield is falling off a cliff. And you hear the inversion of the yield curve. This is what it looks like. This is the yield curve, which is the one they talk about on CNBC. It's they compare the 10-year versus a 2-year. And if I put my marks on it, this is when it inverts. It inverted recently. It stayed inverted for a few days, and now today, and yesterday actually, a little bit above inversion. What it means is that the short-term rates become higher than the long-term rates. It's unusual. We've all learned that, hey, if you lock your CD for 3 years, you get higher rate, right? Or 10 years. Not in this case. In this case, for a period of time, it was higher interest rates for shorter term than longer term. Makes no sense. So this is where the problem comes in for the bank. Sorry for this long introduction. Banks borrow short term and they lend long term. So if the yield curve inverts, in theory, they can't make any money lending. So that brings a worse P&L. And it's harder for them to make money. Not to mention it brings the economy problems because if banks don't want to lend, companies can't expand, people don't start businesses, etc. So they don't buy equipment. But in this case, for banks, I think it's a fallacy that it's not true. They're going to make money. I mean, they have fees left and right. They don't borrow on the 2-year yield. They borrow on the overnight lending rates, which is what the Fed controls. And the Fed has to cut rates, so they'll find balance again, is what I'm saying. The Fed will fix it for them. So how do I trade? So let's get specifics. First of all, when you talk banks, Wall Street consensus is JP Morgan is the cream of the crop. So I can make an assumption for all of them. They're all quality stocks. They're all cheap. I'm going to talk about 3 today: JP Morgan, Bank of America, and Goldman Sachs. And I'll tell you what I like and I dislike about each of them and how I would trade it. So JP Morgan is the cream of the crop. That's the perception. I don't care if it's reality or not. That's perception. It's cheap, probably low, is it single digit PEs? Maybe. It sells at near book, which means if you liquidate the company, you get your money back. Yeah, it's under 10 price to earnings ratio. That's pretty cheap. It can get cheaper, but it just tells me that there is a bottom below it. Can't get a lot more cheaper. Why? Because they all pass the test, the stress tests. So we know they're bulletproof balance sheets, and they're paying dividends. That's because they're healthy and it's a good return on their investment, and they're buying back their own stocks. And that is true for at least Bank of America and JP Morgan, 100%. Goldman Sachs with an asterisk. Okay, so Citigroup could fit in there, but Citigroup perception, again, is that it could have some sort of a hidden skeleton in the closet with its ties to Deutsche Bank somehow. So not sure about it. Don't want to risk it. Why bother with it? Citigroup is probably the cheapest on the book value thing. So these are assumptions. There is value below. So if stock market corrects, then these guys should have less froth in them to shed. For perspective, this was the Christmas crash. This is JP Morgan. This was the March correction, and this was the May correction. We are setting higher lows, and we are retesting the May area, and we bounced off of it. So they all look the same. Let me change them. I'm going to go to XLF. Kind of looks the same. BAC kind of looks the same. Go back to JP Morgan. Let's see, Goldman Sachs. Okay, and JP Morgan. So I can buy the stock and hope they rally. I don't like that because, first of all, if I do want to do that, I'd rather buy it when it breaks out of 111, for example, for JP Morgan on the daily chart, because that's where they failed several times. It's a pivot point from a long time ago, and it's the debacle, the accident scene from last year. So clearly, it's a point of contention. I don't want to bet that this time the bulls will go through it. I'd want to wait for them to go through it, close above it, and then I'll buy it. That is if I'm buying it, calls or stock or whatever. If I'm buying hope, I want to see proof, confirmation that they're going to do it this time. And so here's trigger number one for JP Morgan. I do not buy it unless I see close above at least 111, 110, 111. I want to see them show me that they want to do it. Maybe close this gap and see if they can hold it. 111.5, 112. I'd rather miss $1 or $2 of upside than grab it and then go. Okay, that's my personal opinion. However, if I want to trade it today because I think it's going higher, but I don't want to risk a lot of money out of pocket, if I'm willing to buy the stock at 111, why not buy it at 95? What? Yes, I could sell puts out to December at $95 and generate income out of thin air. If I'm willing to buy 100 shares at 107, 110, why not collect money now? And all I have to do is promise to buy them at 95. Let me go get actual quotes, actually. I'm speaking by estimate here. Let me go get a quote. Okay, as of close today, 9/4, September 4th, the December 95 put is about $1.50. So somebody will pay me $1.50 today to buy their shares of JP Morgan at 95 if it goes to 94.99. So if somebody wants to buy insurance at 95 with their JP Morgan stock. If I'm willing to buy it today at 110, why wouldn't I say, you know what? I'll take your $1.50 and I don't even have to buy the stock, and I can basically profit $1.50 per contract. Each contract is 100 shares. So this way, I open the trade today. Nothing goes out of my account. No out-of-pocket expense. Money goes into my account. The money is not mine. Think of it as a liability on the balance sheet. When you take an order for something and you haven't performed the services yet, it's like an insurance company. They can't claim the income until they know they're not going to pay out on it, right? So once the time passes this year, if JP Morgan is above 95 or stays above 95, the person who paid me $1.50 wasted their money, and I profited, and I didn't even need a rally. In fact, JP Morgan can fall. What the heck is 95 right there? 13, 14, 15%, and I still don't lose money. Now, what happens if it goes below 95? Below 95, I get put to stock, meaning I'm forced to to fulfill my promise of buying it at 95. I don't have an option. I have to do it. And anything $1.50 below that, I start losing money. So my break-even point is 93.5 because I collect $1.50 to open it. So I'm not losing money until 93.50 or lower. Not a big deal because I was willing to buy it up here. So I'm way ahead of the game. So this way I can profit without even needing a rally. The same concept works on the other two stocks. Okay, this is called selling puts. Now I never sell a put, never, unless I know I can and I want to buy the shares at that price. Otherwise, it creates a problem with the account. You get a margin call, say, hey, you promised you would buy the shares. Believe it or not, they'll let you sell the put to a degree without having the money in the account, which is pretty crazy. But anyway, so this is the JP Morgan. So where would I put a stop if I own the shares? My first stop, if I'm aggressive, would be right here, 107.40. Anything below that tells me that they're probably going to retest this neckline. Anything below 104.4 tells me that they probably want to go back to the century mark. Okay, otherwise, why would they lose it? Because technically, this is like a test of a neckline that fails. They call it inverse cup and handle, head and shoulders, whatever it is. This is not typically head and shoulders because of these two pokes higher, but it's a neckline. If you want me to visualize it, trust me, I'll tell you, it's in plain simple English, they're attacking the neckline and the neckline breaks, you know, something like that. This is the neckline. Okay, I call it the ladybug formation. They call it inverse cup and handle. I call it ladybug. So they come down as big as this usually. But to me, before this happens, I look left. I bet you there'll be nice support right here. Actually, right here first, then right here, then right here. These are eyeballs. Then there's no reason to go down to here, so somewhere around here. Which brings me to 95. So I didn't pick 95 randomly. I visually picked it because my eyes are trained to look at these charts and see the spots. And 95, that's where I think it should the wheels fall off the wagon, so to speak. All right, so same concept for Bank of America. Almost identical chart, almost same neckline being tested. The Christmas debacle has been testing the corrections from March and May. So again, a lot is at stake at 26.20. Anything below that, they'll open the floodgates. First to here, and then the Christmas debacle. So I don't want to chase it until they break above 27.70 or ideally 28. Another trigger line would be at 28.50 plus. Maybe they'll fill the gap, but this would be definitely resistance. This is the point of control for the whole year, meaning as soon as it hits there, that's where bulls and bears love to fight it out. That's what they've proven in the past year. So as soon as it gets there, there's going to be congestion. They're going to fight it out again. What does that mean? It just stalls. Buy, sell, buy, sell, buy, sell. Boom. It hits the wall, right? So this is what that means. So again, I don't want to buy it and hope it rallies. I can generate income by selling puts in it. And in this case, I'll be more aggressive in it and I'll sell the 25s for several reasons. This gives me almost 90 cents. But if you consider on a $25, $28 stock, that's a lot of money in relation to the whole price. And I don't even need a rally to profit. And all I have to do is buy it at 25. And my break-even point, this is 25. My break-even point would be almost at 24.10, which puts me pretty close to the Christmas debacle. Yes, that would be a level I would commit to it. So again, here, I'd sell a put to somebody out there that wants to protect their shares in Bank of America below 25. So as soon as it hits 25, yep, I'll buy your shares, pal. Give them to me. Meanwhile, they paid me almost $1 for it. I keep my dollar. My break-even is $1 lower than this. That's a risk I can take. So I have, what is that, a 10%? Yeah, 10% buffer between current price and where I start losing money. Actually, less than that, where I get put the stock. It's more than that if I consider where I start losing money. Way better than buying and hoping, in my opinion. Now I can do both. I can sell the put, get some money, buy the shares, or buy calls. But then I'm really long Bank of America. To me, I'd rather sell. And if I can't sell a put, I'd sell a put spread. So I'd sell the 25, buy the 20 below it to limit my risk to the oh crap moment. I'm just saying. I'm just throwing it out there. So that's the Bank of America. both identical. It's whichever I prefer. Now comes in the little tizzy with the Goldman Sachs. Now Goldman Sachs, if you've noticed, for the last 5 years, Goldman Sachs is the only one that's stuck in the middle of its range. And more importantly, these three dots right here were pretty significant for me, because they were the peaks of a head and shoulder that brought this. And I wrote up, way back then, I wrote it up that it's going to fall off a cliff, and it did. But then they went back above it, they went back to it. So if you look eyeballs, that's like halfway through. So why are they stuck still halfway, right? If I go to JP Morgan on a 5-year chart, you won't see this. You'll see a step up. They were down here, now they're up there. I bet you Bank of America would look the same. Yep, they were down here, and then they were up. Oh, by the way, look at 25. This was a change of scenery. Big 5-year pivot point. And if I look eyeball, that's about half the rally of this. So that's another level of comfort. Back to Goldman Sachs. So I don't like this fact. So that tells me that there's something else that I don't know about, and that's an extra risk. Now that extra risk makes it probably more potentially profitable, because the options premiums are a little more exciting. So I could collect more, but that's because there's more risk. So the same concept here. And if I want to own it here and hope for a rally, again, the trigger point for me would be above 206 or 209. These are not picked at random, but those are my eyeball points of where I would buy it to chase a rally. But this was a pretty emphatic red candle. I don't remember what happened here, but I'd want to know what happened here and see what are the likelihood of the bulls taking it back out. So that's my opinion. So now that could be that they're going to do this and rally to 230, but I would wait for, trigger number one at least 206, maybe 207, but definitely 208 or 9 to chase it higher. Now, bug out moments would be, depends on my level of comfort, but definitely 193. Below 194, I start sweating. 193.70 something looks like a place to get out. 190-ish held, but there's a little open gap down here. Why the heck is it there, right? 184, 185. And it's also here. And look at this, 185. So looks like 185 is of interest. So I could sell the October 185 put and collect a ton of money for it, relatively speaking, and not even need a rally. But again, this is Goldman Sachs. Selling a put naked is a little more exciting than selling the other guys, because the other guys are a little more boring. This one has the history of trading, and it's Goldman Sachs, for crying out loud. So tends to be a little more exciting, and I put that exciting in quotes. So there are trades there, but I'd be more cautious. Maybe the boring trade would be going out further in time and lower in level. Let me check. Okay, so you're gonna love this. The 180 October put pays me about $1.50, and 180 is $5 below that funky, interesting level that keeps coming back. 185, right here, right here, right here. So I'd like to hide behind it for October. Now, if I'm going on vacation close to October, I don't have time to watch it so closely, I want a little more buffer, the 150 longer term would pay me about $1.50. I think it's January, either December or January, I can't remember now, but a little further out in time. So what does that cover? That covers the whole Christmas crash. So the same amount of money, a little longer time, gives me a little bigger buffer. So from here down to 150, 25% eyeball. So again here, selling a put naked is pretty dangerous. I could sell a spread, limit the risk, limit the reward, but then I'd sleep better knowing exactly how much I could lose in the oh crap moment. So again, all three of them have trigger lines up and up, down. I'd rather wait for the triggers to happen before I chase. If I'm anxious to go long now, I'd rather sell puts or put spreads. So this way I don't even need a rally to profit. Now this here was a complete coverage on the financials and the three that I picked, but that applies to all of them that are quality. That includes Morgan Stanley maybe, Citigroup I noted, XLF in general, but careful on the XLF, believe it or not, little known fact, the biggest element of the XLF is not even a bank. It's Berkshire Hathaway. So it's like 11 or 12% of the XLF, right up there, I think, with JP Morgan. So don't know why, but it is. So be careful with that. This is a pure play on one particular company with one P&L, so it's easier to make it tangible of where I'd want to own it versus the XLF. It's just, an ETF. So also it's a lesson on some technicals. Where do I chase? Where do I wait? What's the level? And also a lesson on options. Why would I want to sell options versus buying the shares? And what's the advantage? And what's the risk? Again, nothing here is a trade alert. This is more of us trying to learn different ways of profiting and different ways of looking at P&Ls and companies. Nick signing out.